Welcome to the Virtual Retail Live 2020. My name is Yonah Weiss. I'm a cost segregation expert. You may have heard of cost segregation. You may have even heard of me. I'm the host of a new podcast called Weiss Advice. Check it out. I'm going to tell you today, not just about cost segregation, but about why the best tax deduction just got even better. So we're going to jump right into the CARES Act. Okay, something just happened called Qualified Improvement Property, QIP. We're going to learn all about that. So whether you know what cost segregation is, whether you're a seasoned veteran, or whether you're someone new and you just heard of it for the first time, and it's like, what's this all about? You're going to learn something new today. So we're going to learn what's bonus depreciation, what are the benefits, who should be doing this, when should you be doing it, and what's a real estate professional. If you don't know what a real estate professional is, it's tax terminology. You sure should. Then we're going to do a case study going into an actual shopping center, seeing what the tax benefits are in that property and seeing how you as a retail property owner or a broker can share this information and take amazing benefit of the tax deductions related with real estate. So just a disclaimer, this is not tax advice. I'm not your CPA, not your attorney. Make sure that you seek your own counsel. This is just for information purposes only. Thank you, Madison Legal Counsel. And just to give you a background, depreciation, it sounds negative, right? Things are going down in value. Oh no, really, real estate's going up in value usually. So depreciation is a borrowed term. It's taken from the fact that things do go down in value as time goes on, and IRS gives you a tax deduction based on that. So we're gonna learn all about today how that works. So the first thing we have to know is that for retail, or commercial properties, there's a 39-year schedule. That means that you take your purchase price, divide that by 39, that is your depreciation deduction every single year. For residential properties, it's 27.5 years. But I figure most people here in retail, some of you might own both. A lot of people diversify their investments, it might be you. So you need to know that. There's a tax planning strategy. So this is where cost segregation comes in. You don't just have to take that entire purchase price and depreciate over a 27.5-year period. You can actually, or 39-year period, you can actually take that over a much shorter period of time by doing a cost segregation study, having an engineer allocate those components and depreciate at a much faster rate. So here's a quick overview. Let's say you buy a building for $1 million. Always you're gonna have to allocate a certain amount for land. Land does not depreciate, but the rest of the building and everything that's on it does. $850,000 is going to be your depreciable basis. That means that's the amount you can take as a tax write-off. Let's see how this works. Straight line depreciation would mean that's what most accountants are doing, okay? So you may be taking straight line, which means you take a little bit every single year for 39 years. That means you're taking a deduction of $21,000. That's pretty good for $1 million purchase price to get that. If your net operating income from that property is $50,000, $70,000, $100,000, that's great, but you're left with, you have that deduction, $21,000, you're left with paying tax on the remainder. Cost segregation is a way to actually increase those deductions earlier on in the ownership of that property and get major tax benefits by paying little to no income tax. So the fundamentals, how do we do this? We have an engineer, okay? Someone who's qualified, knows the tax code and knows building construction engineering to walk the property, okay? Now we're doing actually virtual site tours because we're working in the COVID situation. But it's really cool that we're able to have a video conference and have technology that allows our engineers to look and video every single thing in the property. So walking the property can now be done virtually. Hands off, hands free. This is something that we've developed as Madison Specs, the largest national cost segregation company we've done because of this situation. So we're going to reclassify all the property and we're going to show you in the next slide or two what those examples of. What exactly does get reclassified into a faster life? Then we're going to accelerate the depreciation deductions. Because think about it. If you have a building that's worth $1 million and just multiply the millions, okay? $1 million and you have a 2 to 3% deduction of $21,000. It's a little more than 2% deduction on that purchase price of $1 million. Now you can probably take 15 to 20, sometimes even more percent of that over the first 5 years, which means accelerated depreciation, much larger depreciation deductions. Okay, so here you go. This is directly from a shopping center, the case study that we're actually going to see later towards the end of this presentation. Here you can see here, there's two main categories that happen in a cost segregation study. Besides for the main structure of the building that actually depreciates on a 39-year period, meaning the value of that component, the roof, the walls, okay, the actual structural things, structural plumbing, structural electric, all that stuff, doors and windows, they're integral to the building. The assets, those assets depreciate on a 39-year schedule. You can take those deductions over that period of time. However, personal, tangible property, like tons of stuff. Here, these are real life examples from a shopping center. Building mounted flood lighting, decorative moldings, dryer vent kit, emergency lighting, rubber floor, it goes on and on, security system, millwork, mirrors, carpeting, goes on and on and on and on. Okay, loading duct equipment, emergency generator, all this stuff, the value of all those things are identified by the engineer. You know, how much square footage is each, how many units are each, etc. That amount, that value is now taken, depreciated on a faster schedule. Same with the 15-year property. And this is huge on commercial, especially retail properties, because a lot of times you have large, what's called land improvements. Remember, I told you land does not depreciate? Land, you have to subtract from your depreciation basis, but land improvements, anything that's on the land, is considered 15-year property, meaning you can take the value of that over a 15-year schedule. Okay, so this is huge in shopping centers. In fact, much more than any other type of property, because there's huge parking lots. Okay, a large amount of the actual property that you're buying is in the asphalt paving, the bollards, the concrete. Okay, retaining walls, fencing, landscaping. Okay, storm water systems, railings, signage, all of that stuff gets depreciated on a 15-year schedule. Again, we're going to take that value and take those tax deductions in over 15 years instead of 39. We're greatly increasing our tax deductions earlier on. So why are we doing this? Because it's time value of money more than anything else. If you think about it, if you had $1 today, it's better than having $1 5 years from now, right? Because not only inflation, everyone knows that inflation is reducing the dollar by 2-3% a year sometimes. You can actually take those deductions now. And we have to realize the money that you earn is your money. The money that your company's earning, you should be able to use that money as much as possible to reinvest in the properties, reinvest in more properties, reinvest in the business. Therefore, you should be able to take your tax deductions now and not have to wait for it. Think of it like borrowing an interest-free loan. Either you can think of it like this, borrowing an interest-free loan from Uncle Sam that maybe you're going to have to pay back later on. But I like to think of it, you're actually borrowing from your future self or your company's future self, because yes, you may have to pay those tax bill later on because you're going to get less tax deductions later if you're taking more upfront. But I'd rather take that interest-free now, use that, and then worry about the taxes I might have to pay later on. So that's what we're doing. We're increasing the cash flow, and bonus depreciation is huge. We're going to get into that. Who should be doing a cost segregation study? This is a question a lot of people ask. It really depends. Anyone who is taxable. So if you're a nonprofit organization, can't do it. If you are investing from retirement funds, or you have investors from retirement funds that are not taxable, they can't do it. It's probably not beneficial. If you are a government agency, not beneficial, right? However, anyone else, this is going to be huge. It can be, if you're an LLC, that means that you're just splitting up the depreciation according to your percentage of ownership. That's huge. Okay, you're getting a lot of tax deductions. What's a real estate professional? Now, this is very important. I said I was going to get to it. I said you should know what this is because it's a huge thing. It's a tax status. Okay, this is definition from the tax code. I just made the fonts a little pretty over here, but this is directly taken from an IRS publication. A real estate professional is anyone who either they or their spouse is materially participating in real estate trade or business for more than 50% of the time. So 2 qualifications. You or your spouse, only one of you needs to qualify for this and get this huge tax deduction. I'm going to tell you in a minute why this is so important. But to qualify, you have to spend more than 50% of your time, so your full-time job. And number 2, 750 hours a year. So you can't just retire and still get this status. You actually have to show work being put in. So anything you're doing, if you're developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, brokering property. So if you're a real estate broker, and I'm sure there's a lot of real estate brokers listening to this right now, if you also own real estate, you have this status, which means you're spending those hours, you may as well take advantage of the benefit. What's the benefit here? This is probably the number one best rule in the entire tax code. Now, I don't know the entire tax code, so I'm just saying that, but take my word for it, as you're going to see. Usually, passive real estate professionals, there's something called an active real estate professional, like we just talked about, and a passive real estate professional. If you earn over $150,000 of adjusted gross income, you basically lose out on any depreciation beyond your properties. Okay, let me take a step back. Depreciation, as we mentioned, is a huge tax deduction. It's awesome, especially awesome when we're doing cost segregation and creating huge tax deductions in the earlier years. However, those deductions are limited to the income from the property. Okay, or properties. If you own more than one property, it can actually offset all of the income from all your properties. However, if you're not a real estate professional, it stops there. Okay, which means you can no longer use that against any other income. However, if you are a real estate professional, you can now use the tax deductions. Okay, huge depreciation, bonus depreciation, and use that to offset not only income from your properties, but any other income. If you have active income, if you're a broker, you're making deals, if you have a spouse that's a W-2 income, high income earner, you're gonna get those tax deductions from real estate, the depreciation, and now use that to offset any or all of your active income as well. So that's why it's so huge, because you can be making $1 million in other business, have real estate, and create $1 million of tax losses, even though you may only have $100,000 of income from the property, create $1 million of losses, and now use that to offset your other income as well, literally pay little to no income tax. So that's really the benefit of the real estate professional. So now we're going to jump into what's been happening with the tax code with regards to cost segregation over the past few years. We're going to talk about the Tax Cuts and Jobs Act of 2017. Some people call it the Trump reform, tax reform, whatever. We're going to get into, after that, the CARES Act that just happened a few months ago at the beginning of COVID, and we're going to go into how that has affected very drastically cost segregation. So the first thing is they introduced something in the CARES Act, Tax Cuts and Jobs Act, called 100% bonus depreciation. It wasn't a new law entirely, because it used to just be relegated to new development. If you built a property, ground up development, you could have taken 50% of the accelerated depreciation deductions in the first year as a tax deduction. Comes bonus depreciation, Tax Cuts and Jobs Act moves it to 100%, and now any property. So if you go and buy a used property, meaning it's been in service, it was built in 1952, it was built in 1974, you go and buy that building, now this is the kick. And I didn't mention this before, but I should have. If you're still on this and you're paying attention, think back to when we talked about depreciation, that $1 million building, you're getting those deductions, but it starts over. Remember, I told you depreciation is just like a borrowed term, because the schedule, that 39 years, is not intrinsic to the property. It's intrinsic to you as the buyer, which is crazy. That means when you buy a property, your depreciation schedule of 39 years starts over day one when you buy it, when you place it in service. Get this, you can buy a building built in 1974 for $1 million and now take bonus depreciation, which we're going to see in a second how massive that is. Your schedule starts over day one from when you buy it. What is bonus depreciation? Anything that accelerates, okay? Any depreciation that's in those faster categories, 5 years, 10 years, 15 years, like we mentioned before, if we go back to those slides, all of that can now be taken as 100% tax deduction in year number one. And we're going to see in the case study very shortly what that actually translates to, okay? We're talking about 20 to 30 to 40% of the actual purchase price as a first year tax deduction. Let me say that again so it sinks in. You buy a building for $1 million, your basis is $850,000. You take a 30%, okay? 30% tax deduction of that purchase price. In year number one, you're talking about a $250,000 to $300,000 tax deduction, tax write-off in year one for buying a $1 million building. Now remember, you financed that purchase probably. You didn't pay all cash. Maybe you did, maybe you didn't. Maybe you did owner financing. Maybe you did some creative things that you actually didn't even put any money down or little money down. Guess what? You get depreciation based on the entire purchase price. Okay, that's huge. $1 million tax, $300,000 tax deduction for buying a $1 million building. Game changer. This will, however, phase out in 2023. So now is the time to take advantage of it. It's going to start phasing out. 2023, it's going to go down to 80% bonus depreciation, then 60, 50, et cetera, until in 2028, there's no longer going to be bonus depreciation. Okay. So again, it's 100% of that. It's anything that depreciates less than 20 years. That's everything that we're identifying in a cost segregation study. Remember, you have to do a cost segregation study in order to elect bonus depreciation. It's an election. Once you do the cost segregation study, you can either choose to take it the regular cost segregation way, which is accelerating depreciation, or you can elect to take 100% bonus. We prepare both schedules for you when we do that study. No need to worry about that. You can just pick and choose which one's going to be best for you. You cannot do it if you're buying and selling property in the same year. And this also does not apply to a 1031 exchange or a non-arm's length transaction. It does, little asterisk there, parenthetical, it can apply to a 1031 exchange. This is a little complicated, so I'm not going to go into it. Talk to your tax advisor about this. There are definitely ways to do it depending on how you're transferring the basis of your property. What about the CARES Act? We just had this huge tax reform, huge income, entire economy upheaval, and the government came in, stepped up, and gave a lot of tax benefits. A few of those we're going to talk about today and how they apply specifically to commercial real estate. So the first thing is something that's called QIP, Qualified Improvement Property. This was a new thing. See what happened in the Tax Cuts and Jobs Act in 2017. They kind of conglomerated 3 or 4 different things. There used to be something called qualified leasehold improvement, qualified restaurant property, qualified retail improvement property, and qualified improvement property. And they were all lumped together. And basically, I'm going to tell you what they lumped it together into one thing called qualified improvement property. What this means is if you have a commercial building, doesn't apply to multifamily, residential, only commercial, and you did interior, non-structural improvements to that property after the acquisition of the property. Okay. So you bought a building, you did some major renovations, and those renovations included, cosmetic improvement. You put in new equipment, you put in new furnishings, you put in, new lighting, whatever it is, all that stuff that's interior improvement, non-structural, cannot include enlargement to the property, cannot include elevators or other non-cosmetic improvements. But any of the money spent is now, instead of a 39-year period, now that gets QIP, 15-year schedule. Guess what? 15-year schedule means less than 20 qualifies for 100% bonus depreciation, which didn't happen before. It should have. This applied to multifamily property. You can do improvements on multifamily and other type of assets, but for restaurants, et cetera, retail, this was left out of the Tax Cuts and Jobs Act for some strange reason. It was a technical error, a lot of people say. However, now it's in force, in play. If you did improvements to your property during 2018, 2019, you can take advantage of this, take 100% bonus depreciation. That means a complete tax write-off of all of those assets that you placed in service, and you can get that as a tax deduction. The second biggest thing that happened with the CARES Act is something called, they reintroduced something called net operating loss carrybacks or carry forwards. Now you might ask me, Yonah, what happens if I do this cost segregation study and I have way more deductions than I even have income? And that can happen. If you have a $20 million building and you're creating a $5 million tax deduction and you only have $3 million of income, okay? What happens with the extra $2 million? So it used to be, it was carried forward, okay? Carried forward, and it used to be just carried forward to 80%. They changed that in the Tax Cuts and Jobs Act. Now you carry that forward 100%. What do you mean carry forward? You don't lose that. You just can't use it this year. You can carry it forward to the next tax year and you can use it then. However, they reintroduced something called net operating loss carrybacks. Carrybacks means, and again, I'm not a CPA, I'm not your tax advisor. Don't take my word for this. Make sure you check this out and you double check this out. But what happens with the net operating loss carryback is if you have extra deductions this year, you can now, and you paid taxes in the past 5 years, you can now go back, amend your previous year's tax returns, and get a refund check for any of the taxes that you paid, because you are now carrying back those losses. Instead of using them this year or carrying them forward to future years, you can carry them back, take huge tax deductions. The government put this in as, kind of a way to accelerate the growth for the economy, people that need the extra boost right now. I think it was good. You probably agree too. So again, this needs to be done. It's a little more complicated because you need to amend your previous year's tax returns. You need to file special forms of the changing of the net operating loss of that, but it still does exist. Now, what happens? When is the best time to do a cost segregation study, you might ask? Great question. Anytime is the best time. No, I'm just kidding. Really, what happens is it depends. Okay. If you buy a property, you can check it out. In fact, we offer a free service where we will provide an upfront estimate for you. What your cost segregation study is going to do, how's that going to affect your bottom line? What's it going to look like compared to if you're taking straight line depreciation? So you can see upfront what your tax benefit's going to be. A lot of people do it right away after acquisition, first year. Make sure to get those tax benefits in the first year. If you get extra losses, carry that forward. 100% bonus depreciation, no problem. Create that, carry it forward. When you're doing a major renovation, like I mentioned, not only do you get the CARES Act QIP, but you can do anything and you can get that tax deduction on the money spent because your basis, again, how much you're depreciating is based on what? Your purchase price. And now any money added into the property is also depreciated. Carry that forward, use that as a cost segregation study. However, you can also do it, obviously, on new construction. The engineers are going to look at the invoices, going to look at the AIA documents, and going to allocate everything to those categories. But you can also do this looking back. You can do a retroactive cost segregation study, which means this is without actually having to amend any tax returns. If you had a property you've owned for a number of years and you're just doing straight line depreciation and you're like, hey, now I actually need a lot of tax deductions. I would love to do that. Can I do cost segregation study now? I've owned this property for 5 years. Yes, you can. You go and do what's called a change of accounting method. No amended returns necessary whatsoever. You can get retroactively all of the accelerated depreciation that you missed. And that's pretty cool. Okay, so the CatchUp Depreciation, you file a form 3115. Again, this is something that we do for our clients at no extra cost. It's an automatic method change. No worries, you can get it all in year number one. Moving forward, what types of properties get the most tax deductions? Because we've been talking about this kind of, in a box, and we're going to get to the case study right after this slide, so stick around. Auto dealerships, right? They're great, about 25%. Grocery stores, 35% average, okay? Some are more, some are less. Hotels, manufacturing. A lot of the people watching this are probably in retail, so restaurants and things like that, 35%. That means 30 to 35% of the actual basis, how much your tax you can reallocate to those faster lives and get those tax deductions faster. So you see a lot of properties have a lot of, awesome tax deductions here. Offices are a little bit less, warehouses, obviously less, mobile home parks, huge, off the charts. If you're interested in that, or golf courses, reach out to me, talk to me about that later. That's not for now. So here's the case study, guys. We are looking in a retail property. Okay, this was the Garden Plaza Shopping Center. It's a one-story, multi-tenant shopping center, 93,000 square feet, purchased for $12.5 million. Awesome. Now, without a cost segregation study, you divide $12.5 million, you take off 15% for land, and it could be more, could be less, but that's what this property owner did. This is a real case study. Took off 15% for land. Guess what? If you divide that by 39 years, that means your yearly depreciation deduction is $272,000. That's awesome, right? But if your $12 million shopping center is creating over $1 million of net operating income, guess what? That $272,000 is not going to get you too far. What do? You bring in the guns, cost segregation. That's right. This is exactly what it looked like, okay? And you can see here on this property, huge, right? Many shopping centers are like this, huge landscaping, huge parking lot, lots of lighting, all the shopping carts also, well, that's more like equipment and stuff like that, but you can see the signage. What happened? Check this out. 15% to land, 1.875 million. The rest of it, 5-year property. Remember, that's all of the furnishings, the equipment, the lighting, all the stuff inside the building that's not structural. 15%, okay, over $1.5 million of accelerated depreciation. 15-year property, that's the land improvements. Remember, all this parking space, all the stuff, the retaining walls, the curbing, all that stuff, 20% of your property, of your basis is allocated to that. We're talking 35% reallocation. And what was the 39-year period? This is a mistake. 39-year period is, that's 65%, $6.9 million. What is that total up to? $3.7 million of either over a 5 or 15 year period of accelerated depreciation, or in a first year tax deduction on a $12.5 million purchase, bonus depreciation, $3.7 million bonus depreciation tax deduction. That's huge. That's a game changer. I'm going to share my, my screen over here with something else just to show you something. I didn't put this in the slides over here, but if you can, new share, if I can do this, check this out. Can you see that? So now you can see this is actually, you know, different calculations and stuff over here. This is what a real cost segregation study actually looks like. Okay, you can see it's 92 pages long. It's really, really detailed. A lot of stuff. It's going to go into description. I don't know if you can see that. I'll try to zoom in here. Description, right? Quantity, 299,000 square feet of asphalt paving. Guess what? You know how much money that asphalt paving is? It's a lot of money. It adds up really quickly. Okay, so these are the calculations. $1.4 million. This is awesome stuff. So this is what a cost segregation study looks like. I'm going to go back to, and this is your depreciation schedule. So again, you're going to see in those first 15 years, a huge amount of depreciation. Instead of $272,000 every year, we're talking about first year 390. Even if you don't do bonus depreciation, 920, 680, a lot of depreciation in those first years with cost segregation. Okay, so I'm going back to my old screen. Here we go. We're back. Okay, what do you look for in a cost segregation study? Now, if you go to the IRS website and you look for something called the IRS Cost Segregation Audit Techniques Guide, this is what you're going to find. It has, there's all this nomenclature, all this methodology, a whole numbering system, an analysis. You have to have an engineer actually do it. So there's a lot of detail that goes into it, which is why you need a quality cost segregation firm to do this kind of stuff, which is really where Madison Specs comes in, because we're the largest national firm to do this. So highly recommend you reach out. This has been a lot of fun. I'm not going to go too much into what else you need, but you want to make sure they're engineers and accountants. A lot of large accounting firms will do this in-house. We happen to work with some of the largest corporations in the country, REITs, large corporations doing several billion-dollar transactions. So you want to make sure that you have that in-house. Okay, you're not looking for a fly-by-night. And make sure they have the audit defense, because if ever to get audited, you want to make sure your cost segregation study flies. Okay, Madison Specs, like I said, we're doing this for 15 years, 16,000 cost segregation studies done, all asset classes, over $3 billion in tax savings, 100% audit protection. That's pretty much it. I'm Yonah Weiss. It's been a pleasure. You can reach me at yonahweiss.com or just find me on LinkedIn. For goodness sakes, don't you know me from LinkedIn? It's been fun. Have a great rest of your conference, and good luck to Stacy and the team. This has been awesome.